Welcome to the 2020 Family Matters Conference, the financial empowerment section. So COVID-19 has unmasked some grave disparities in healthcare accessibility, economic stability, and is widening the educational gap here in the United States. The trauma that we're experiencing today, however, does not need to be an indictment on our future, so we can change this story. First, thank you to Pastor Mouton for allowing me to participate in this conference and to share what I know about finance. And prayerfully, it'll make a positive impact on your journey to financial freedom. So I'm Gabby Delisme, and I manage a financial education company called Facing Finances. We opened our doors in 2014 to educate, empower, and equip those who have historically been underrepresented and underserved while on their journey to financial freedom. So it's the missteps that I've taken that have allowed me to see that really it's not about the amount of money that you bring in. It really comes down to how you're managing what you've been given. That's stewardship. So no greater love. Y'all remember when we covered stewardship during the fourth quarter of last year? It was as if God was preparing us for this season, right? So you're viewing this on July 25th, and by today, my first book, Manage Your Money, will be published, and I'm prayerful that it'll be a blessing to anyone on the journey to financial freedom, especially during this season of COVID. I also serve as the Business Intelligence Manager for Hillsborough Community College. It's a fancy title, at least I think it's a fancy title. And it really just means that I work with corporations across Hillsborough County to identify training opportunities within their organizations, and I help develop training programs that will improve the skill set of their staff. So most recently, I've been named as the Rapid Credentialing Grants Program Coordinator, and we're going to talk about that a little bit later. Let's dive into finance. And let's start by talking about some of the facts. Before the pandemic, 78% of workers in the United States said that they're living paycheck to paycheck just to make ends meet. Before the pandemic, only 40% of Americans said that they would be able to pay for an unexpected emergency of $1,000. Oh, one thing that I forgot to mention, at the bottom of each slide, you'll see a website that we've set up to house digital resources that are designed to help you along this journey to financial freedom. After the conference, make sure you head over to the website to access this content. This chart is as of April, but the data for June says the same thing. Close to half of Black adults are not working. When you think about the number of Black and brown people working in what has now been deemed essential positions, the Black unemployment number would actually be much higher if we didn't hold those positions in such high numbers. This is not to sound doom and gloom, but it's just to show where we are now so we can help prepare for what is to come. This chart shows our progress in terms of income since 2000. When you compare 2018 to 2000, the income of Black people is actually lower than it was in 2000. There are some pretty significant things that happened during this 18-year period of time. Does anyone remember the dot-com bubble? And when that burst in 2000, we had huge companies that were staples in the U.S. economy completely vanish. Companies like MCI and WorldCom, those are telecommunications companies that no longer exist. Thousands of people were left unemployed. The reason that happened was ultimately because cash flow was ignored. So let's fast forward to 2008 to 2010. We had companies like Bear Stearns, one of the primary investment banks, just collapse. Hundreds of other companies also filed for bankruptcy, and thousands of employees found themselves unemployed. We can keep going back in history and find examples like this, but these two events were my primary point of reference because I was working in the financial services industry during both of these seasons and saw my wealth significantly decrease and then shortly thereafter soar because of the measures that I put in place and the behaviors that I developed during the tough times. So now we're in 2020 and COVID-19 has impacted the world economy and millions of people are unemployed. This global pandemic is different because it's a health crisis that has basically turned into a financial and educational crisis, and there is no industry that has been untouched. So this is shifting how we live our lives, and we need to shift as well. So George Santayana, I hope I'm pronouncing that name correctly, but George Santayana said, "Those who cannot remember the past are condemned to repeat it." We have experienced challenging and constrictive financial times in modern history. So we need to just look back to the behaviors that allowed us to get through and excel during those previous times as we develop our plan to soar post-COVID-19. So we know who got us through, and that was all God. Now we need to focus on the what's of getting us through, and that's going to be found in our actions. How can we have a better outcome this time around? How can we change this story? It's going to boil down to managing our money. We have to get intentional about managing our money. Now more than ever, it's critical that we manage our money. As followers of Christ, we know that nothing is impossible with God. Philippians 4:13 tells us that we can do all things through Christ who strengthens us. That's the God that we serve, the God that equips us to do all things. The verse implies that some action, however, is necessary on our parts to tap into that strength that He's willing to give us. So to reap the benefits that God has for us, each of us has to commit to being intentional about how we manage our money. That's stewardship. So the trauma that we've experienced can paralyze us. But truth be told, many of us have been experiencing trauma much longer than just this year. We've modified our lives to live with it, deal with it, or even settle for it. But we don't have to live that way. So let's let today be the day that we can actually treat the wounds instead of just covering them up. So today, we're going to break down some actionable steps that can be taken to shift the trajectory of your finances. These are the topics that we're going to cover together. At a high level, the first three topics: establish a clear financial plan, maintain great credit, and save for our future, are the things that need to be done now to reposition ourselves to soar post-pandemic. Young money is where we'll talk about how you can help your kids be better prepared to manage money, because it doesn't start when they get their first paycheck. It starts with what they learn by watching how you handle money. The rules to managing your money is like the rules of engagement. All right, let's get into it. So we've got to get clear on our what's, our why, our when, and our how. Our financial plans include our financial goals, our spending plan, and our estate plan. So let's talk about your financial goals. Your goals specify the direction you would like to be heading in. It's kind of difficult to hit a target if we don't know where it's at or that it even exists. When it comes to goals, although they're different for everyone, there is one that should be consistent for all of us right now, and that is to preserve as much capital as we can. So when it comes to setting goals, we want them to be smart. We want them to be specific, Measurable, attainable, realistic, and time bound. Let's take 2 minutes to write down your financial goals. Don't overthink it. Just what are your financial goals? What would you like to accomplish? Write them down on the sheet of paper that you're using to take notes during this conference. On the slide that you see, there is an example. So put $100 every 2 weeks into my emergency fund. All right, 2 minutes. Now you've got your financial goals. So you've got one step down and a couple more to go as we focus on clear financial plans. The next thing that I want to talk about before we get into spending plans is this chart. So consumer spending rose in May, and although this chart doesn't show June, it also increased for June. From this chart, you can also see that personal income dropped. So income dropped, but spending increased. What does that tell us? That is, unfortunately, a recipe for disaster. Have you increased your spending? If you have, what's driving you to spend? We all have triggers. And because of COVID-19, we've been in our homes, not engaging in our normal activities, and that's caused some anxiety and us to just try to escape in different manners. So how are you coping with the stresses of today? Are you using shopping as a coping mechanism to escape right now? Is it putting you in a better financial position or hurting you in the long run? Are you trading temporary satisfaction for long-term distress? Don't beat yourself up. I committed to not making unnecessary purchases back in March. So purchases like shoes and clothes during this pandemic, I don't really need those things. And I already have clothes and shoes, right? Well, guess what? I purchased some shoes last week. And I don't have anywhere that I'm going necessarily right now, but I was bored and shopping was just the thing to do. So this is no different than eating out of boredom. We get temporary satisfaction and then feel guilty about what we've just done. The key in reducing the issues, the long-term issues, is to recognize what we're doing and course correct. So reviewing our goals and seeing if what we're doing is in line with achieving them is something that helps me. So given that we don't know what the economy is really going to look like at the end of this month, patience is a fruit of the spirit. We don't know what the world economy is going to look like a month from now. So we just need to temper ourselves in how we operate. So what's the next step in creating clear financial plans? Well, it is to give your money direction. Create a spending plan. Achieving our goals comes at the expense of sacrificing something else, meaning I can't buy all of the shoes that I want and still expect to be able to have the money that I want to invest. In business, that's called an opportunity cost. Everything has an opportunity cost. We just need to assess whether or not the cost is worth it. At its core, your spending plan is created when you identify your income, assign every single dollar of your income to an expense, and that includes saving. Then you subtract those numbers and you make sure that it is zero. Why do you want it to be zero? Well, when it's zero, you know that you have allocated all of your income to taking care of the things that you want to take care of. So if your number is positive, allocate the extra money to savings. If your number is negative, identify expenses that can be eliminated and opportunities to increase your income. The graphic that you see here gives an example of a spending plan allocating all of the monies to different categories. At the end, you see that the expenses equal the income. The overall major components of a spending plan, like tithing, housing costs, savings, utilities, those are pretty consistent on people's spending plans, or should be on everyone's spending plan. But of course, the amounts are going to be different. So use your new spending plan to help achieve your financial goals. If your financial goals serve as your destination, your spending plan is the roadmap to help you get there. In this season of uncertainty, we need to take a hard look at our spending habits and develop plans that have adjusted our spending to put us in a position that will allow us to flourish. We have to know our financial habits. We have to establish realistic spending plans. With income, sometimes there are instances where we're making all of the sacrifices that we can in terms of expenses, and our income still just isn't lining up. So those are times when we need to look at our income and identify ways that you can use your gifts and talents and turn those into a business, turn those into a side hustle. We talk about diversification when it comes to investments, but it's just as important to diversify our income. So take a moment and on the same sheet that you are using to take notes, write out your income. 60 seconds. And while you're putting your income together, make sure to add everything up at the end so you have the bottom figure. All right, you've got your income. So now we're going to look at expenses. So there's a lot to be said about expenses, especially in the season that we find ourselves in right now. So often as we make more money, we face the trap that's called spend creep. That's the phenomenon where our expenses automatically start to rise because we start making more money. Take a hard look at your expenses and decide what you're willing to sacrifice for now so you can reposition yourselves financially. Can you let go of something like your entertainment subscriptions, for example, and utilize the services that are offered online through the public library or other free services? You know, it's estimated that Americans spend $444 each year on subscription services like Netflix, Hulu, Amazon Prime, etc. So what can you get rid of right now? Be honest with yourself. If you're married, it's best to do this with your spouse. If you have a family, have a family discussion about where you stand financially and some of the things that y'all can collectively do to regain or maintain financial stability. Go through everything with a fine-tooth comb, as the saying goes. So let's take 2 minutes to jot down all of your expenses. And once you're done jotting them down, make sure to add the bottom number as well so you can get the total. Okay, welcome back. So you've got your income and you've got your expenses. Now, before we go on to the next thing, because may I tell you, you are almost done creating your first spending plan or the draft of your spending plan. Majority of the folks that are uninsured are Black and brown. There's something to say about having health coverage right now. It's critical during this season of COVID. If you find yourself uninsured, here are a few things to consider in terms of affordable health care. Are you eligible for COBRA coverage? Basically, a COBRA coverage is a continuation of the coverage that you had while you were employed. It can be very expensive. I've had COBRA coverage before, and I know that it was pricey, but in some instances, it makes sense. Meaning, have you already met your deductible for the year? If you have, it may make sense for you to get COBRA coverage. Do you prefer to just utilize the network of doctors that you've already familiarized yourself with? It may make sense for you. Unfortunately, there's typically no subsidy, but it is an option to get coverage. Can you enroll in your spouse's plan? So if you've recently lost your coverage through your place of employment, you don't have to wait for an open enrollment. Typically, the window to enroll in your spouse's plan is 30 days, but because of this global pandemic, the periods have been extended. So if you were delaying Medicare coverage, can you enroll now? There's an enrollment period when you first lose your job, and it's important to enroll so you don't have to pay higher premiums going forward from missing your enrollment window. Medicare.gov is the site where you can get some information about Medicare counseling programs as you transition. Can you enroll in Medicaid or CHIPS for children? And CHIPS stands for Children's Health Insurance Program. A lot of times people become eligible when they lose their jobs because it's based on monthly income, not annual income. Healthcare.gov has screening tools to help figure out if you're eligible and can direct you to your state site. You can also explore coverage through the healthcare marketplace. Okay, so you've got your income and you've got your expenses. Now, this is a screenshot of the third tab that's on the spreadsheet that you'll be able to download. In this season of uncertainty, it's important that we take a hard look at our spending plans. So is your number negative, your net financial position? Is it negative? Is it positive? Is it at zero? Because really, remember, our goal is to have it at zero. And that means you have allocated all of your dollars. You have assigned every single dollar. Every dollar has an assignment. If it's red, go back through your expenses and see where you can adjust again. Also look at your income. If it is positive, allocate those monies to savings. Know your financial habits. What is next? Well, we've got to develop an estate plan. At some point in time, we all know that we will transition from this earth. So proper planning prevents confusion. We don't talk about this enough. Creating an estate plan really helps your loved ones. There are so many emotions that are involved when someone is ill or has transitioned. People are figuring out how to grieve. And when we don't create estate plans, they not only have to deal with the grief, but also the added stress that comes with needing to make medical and financial decisions. So creating an estate plan allows your wishes to be known and followed. There are some documents that really we should have in place. A will, also known as a last will and testament, gives the instructions for the distribution of your assets at death. A living will is different. It gives guidance on end-of-life decisions if you're not able to make them yourself. A trust is a legal entity that can be set up to hold assets on behalf of a beneficiary. It's managed by a trustee, and that person is responsible for carrying out the instructions laid out in the trust document. Because the trust is recognized as a separate legal entity, monies held in these types of vehicles have protections that monies held in different types of accounts don't necessarily offer. Healthcare directives are written legal documents that inform others of your wishes about your healthcare. They allow you to name an agent who's the person that would make decisions for you if you are unable to do so yourself. Medical power of attorney and living will are a couple of examples of healthcare directives, but there are more. Medical power of attorney, also called healthcare proxy, designates an individual to make medical decisions for you when you no longer have the capacity to do so. So the medical power of attorney will only go into effect when you do not have the capacity to make decisions for yourself regarding your medical treatment. The financial power of attorney is a legal document that grants an agent the authority to act on your behalf when it comes to matters pertaining to your finances. There are different types of powers or authority that you can grant to people. So you want to do your research and choose wisely when it comes to executing your decisions. A beneficiary is a person that you designate to receive payment or benefits or assets in an account in the event of your death. You can designate more than one beneficiary, and you specify what percentage each will receive. The advantage of this is that naming a beneficiary wherever possible allows your estate to avoid probate. So there's no court involvement. The beneficiaries just need to show the death certificate to the financial institution, and they can receive assets within typically a few weeks. I said earlier that a beneficiary is a person, but in actuality, it doesn't have to be a person. A beneficiary can be a charitable organization. It can be your church. It can be your college alma mater or any institution. You can even name a trust as a beneficiary. So life insurance. Life insurance is a contract between an insurance company and a policy owner that basically says premiums are going to be paid in exchange for the ability to receive payout at some point in the future, typically death. The insurance company typically provides a lump sum payment that's called a death benefit to the beneficiaries upon the death of the insured party. Now, typically, life insurance is chosen based on the needs or goals of the policy owner. Term life insurance generally provides protection for a set period of time, whereas permanent insurance like whole and universal life provide lifetime coverage. In general, death benefits from all types of insurance are income tax free. It's important to keep all of your documents organized and accessible to those who you plan to designate to act on your behalf. There's also a document in the resources page that will help you to organize this information. Okay, quick recap. In establishing clear financial plans, we're going to identify our financial goals, create a spending plan, and develop an estate plan. If you find conflicts as you create your plans, go back and adjust to make sure that things are in line with the outcome that you desire. So these are 3 practical things that you can do and really should do. All right, now for our next topic, maintain great credit. Okay, maintaining great credit is going to be critical for how we reposition ourselves for life post-pandemic. It boils down to access and alternatives. Why is good credit a necessity? Well, it impacts our employability. It impacts disposable income. People can be subject to higher insurance premiums, paying security deposits for things like cell phones and utilities, even paying the most common thing, higher interest rates for loans when you don't have good credit. The higher interest rates, the more fees that you pay, that means less money that you have each month that can be used to build savings, to invest, to ultimately build wealth. It impacts where our kids go to school. How do we fix this? Well, this is a chart pulled directly from Experian. And really, we want to be in the upper categories. We want to be in the exceptional category. We want to be in the very good category to get the best interest rates. 700 or above is generally considered good. A score of 800 or above is considered to be excellent credit rating. Most credit scores fall between 600 and 750. So the higher the score, as you may already know, the higher your credit scores, the more confident lenders are with lending you money because they deem you to be less of a credit risk. So how do you move into the very good and exceptional credit rankings? Glad you asked. Well, this is a breakdown of what goes into FICO scores. Payment history, amounts owed, length of credit history, credit mix, and new credit. Payment history accounts for 35% of the FICO score, and amounts owed accounts for 30%. Together, that's 65%. That is a huge chunk of the FICO score, and those are things that we can control. Really, all of these are things that we can control at some level. So with payment history, that is, are you paying the bills on time? If you're paying a couple of days late, no one knows except the lender and you. But the credit bureaus are notified once you hit that 30-day window. So set up automatic payments if you are in a position to have your account funded to do so. Set up payment reminders so you're notified when your bills are due also. With the amounts owed, you want to make sure that you use no more than, I recommend no more than 20% of your available credit. So when you look at your revolving credit, so your credit card debt, just keep that below 20%. Meaning if you have a credit line of $500, try not to use more than $100 of that. The remaining amounts, or the remaining factors rather, that go into your FICO scores are the length of your credit history. And the length of credit history, that's a look back at your oldest account on your credit profile. Your credit mix, that's the different types of debt that you have. So student loans, car notes, mortgages. A person with diverse credit is deemed a better credit risk. And then new credit, that's 10%. That's how many new lines of credit that you're opening and how many hard pulls are being done against your profile. These are things that we can actively look at and manage when it comes to improving our credit scores. Now, if you find yourself in a position where you cannot pay your bills, it's imperative that you have a plan and that you contact the lender or service provider. Some options that may be available to you are deferring payments, making partial payments, doing loan modifications, forbearance, just to name a few. But you want to call and find out what is going to be best for your scenario. When making your decision on how to proceed, take into account the impact on your credit scores. So will they be reporting, or what will they be reporting to the credit bureaus rather? So during the last recession, many people, including myself, had lines of credit completely eliminated, meaning I had like credit cards in a drawer unused and those lines were closed. We're seeing the same types of things happen right now. People are seeing lines shrink And they're seeing lines completely eliminated once they have paid off their balances. The credit bureaus, Experian, TransUnion, and Equifax, have all partnered to allow everyone to have access to their credit reports on a weekly basis. Historically, we've only been able to access them one free per year per bureau. Well, now we can check them each week. Head over to annualcreditreport.com, register online so you can get access and just review what's going on with your credit profile to make sure that things can be addressed early. Okay, so we've covered establishing clear financial plans and maintaining great credit. As we move into the next topic on our agenda, I want us to take a look at this chart. So this chart depicts the wealth across households. I'm going to just pause for a moment so we can all see this. So Black households have only 10 cents in wealth for every dollar held by white households. How do we shift this? Our earnings is only one side of the equation. We need to focus on growing what we earn and keeping what we earn, meaning reducing tax liabilities, saving and investing. If you take a look at this chart, when you look back at 1968 and compare Black wealth to now, Black wealth has actually decreased. We do have the ability to change this. All right, so now we're going to get into saving for the future. It may seem like an impossible feat right now, but it's critical that we be in save mode. So where's the money that we're going to save going to be coming from? All right, well, millions of people have started receiving their economic impact payments, better known as stimulus payments. The picture here is actually the debit card that's being issued. Looks very similar. I don't remember the name of the issuer, but if you don't need these monies, set them aside as savings. Do you have a fully funded emergency fund? And a fully funded emergency fund should have at least 6 to 9 months of expenses. So let's take a moment to look back at the expenses that you laid out in your spending plan. Multiply that number by 6, and that is the minimum. Let's say my expenses are $2,000 per month. That means in order for my emergency fund to be considered fully funded, I need to have at least $12,000 set aside. So how much do you need in your emergency fund? Do you already have that amount? If you don't have that amount, make sure that what you have identified as your savings goals are going to help you build that. And by the way, if you've not received your economic impact payment and believe you're eligible, head over to irs.gov/EIP to check on the status of your payment. All right, this graphic right here, I thought did a wonderful job. And so we're going to talk through it. 401k plans, and I'm saying 401k plans because that's what the majority of people have, but they are the same thing as 403bs and TSPs, thrift savings plans. They are all tax advantage defined contribution retirement accounts offered by employers to their employees. There are a limited number of investment options. Automatic payroll contributions are how they are funded. Typically, there's a match. The limits for 2020, $19,500, plus an additional $6,500 if you are over the age of 50. That's your catch-up contribution. You also have the ability within these employer-sponsored accounts to contribute either to a traditional or to a Roth account. The traditional account is pre-tax dollars, meaning you get a reduction in your current income. The Roth, you contribute with after-tax dollars, so you don't receive a current reduction in income, but since these monies are contributed to the account with after-tax dollars, you don't have to pay taxes when you take a distribution from the account. In addition, you don't have to pay taxes on earnings from the growth within these accounts. So right now, we're at all-time lows in terms of our tax rates. So more than likely, we'll have higher taxes in the future. So it's beneficial if we're minimizing the amount of taxation because that goes towards building wealth. All right, IRAs, individual retirement arrangements. They offer thousands of investment options. You can contribute automatically, but that typically comes from you setting that up from your bank account to go into your retirement account. There is a traditional and there's also a Roth IRA. And the same concept. The traditional is with pre-tax dollars. The Roth is with after-tax dollars. The limits for 2020 is $6,000 plus an additional $1,000 if you're over the age of 50. What do you do if you're self-employed? Well, if you're self-employed, you can actually reach out to companies like Vanguard, Fidelity, Charles Schwab, ShareBuilder, and discuss setting up a solo 401k or a uni-K or an individual 401k. Those are all the same thing, but it just means that you are the only person that would be covered under the plan. You work for yourself. You can actually set aside more money than if you are working for a company because you're acting as both the owner and the plan participant. Health savings accounts, HSAs, those are tax advantaged accounts as well. HSAs let you set aside pre-tax income to cover healthcare costs that your insurance doesn't cover. You can only open or contribute to an HSA if you qualify or if you have a high deductible health plan. For 2020, the maximum contribution amount is $3,550 for individuals and $7,100 for family coverage. If you're 50 or older, you can add an additional $1,000 as your catch-up contribution. I like HSAs because there is no use it or lose it provision. Any funds still in the account at the end of the year can be rolled over indefinitely. That's very different from flex spending accounts where you have to use the money in the calendar year or you lose it. So just to give an example, if you have medical expenses this year, but don't need to tap into the monies in your HSA, you can utilize your receipts in future years to take a withdrawal from the account. You won't be taxed. Most employers offer some sort of HSA, but you can actually set one up yourself through institutions like Charles Schwab or Fidelity. Minimized taxation is huge in terms of keeping monies that you have coming in. And something that is not discussed a lot is the benefits of starting a business. There are tax deductions that are available when you have a home-based business. All right, so now we're going to get into young money. Our relationship with money doesn't all of a sudden start when we get our first job or first paycheck. Think back for a moment and recall your first memory with money. Some of us remember being told no, that we couldn't afford something. Some of us remember going to a financial institution with a parent. Some of us remember parents maybe having to ask a family member or friend to borrow money. It's important that the foundation set is one that's going to help kids become financially healthy individuals. So how do we do that? Well, we don't talk enough about money, and the topic becomes taboo. So we've got to talk to our kids about money. The more you speak to kids about money, the more comfortable they're going to become with the subject, and the easier it'll be for them to manage their money as they get older. Allow kids to earn an income. Earlier, we discussed different sources of income. And allow them to start earning an income, whether that be from a business that you own, which you could utilize that as tax write-offs, or whether that be from them exploring entrepreneurial opportunities by looking at their gifts and their talents. Show them how to establish banking relationships and work with them to set up their own spending plan. All of these go into building good habits as they develop their relationship with money. This slide right here is to show some key dates. That there are several moratoriums that are getting ready to lapse. Folks who live in federally subsidized housing who have not been able to pay their rent. Folks who have mortgages that they have not been able to pay, and the loans are backed by federal loans or federal mortgages. Folks who have student loans, those payments, those are going to resume at the end of September. With the CARES Act, the additional $600 in unemployment benefits, that ends at the end of July, at least as of the recording of this video. We have to position ourselves to be prepared once these things end. So how will you proceed? Now is the time to make some serious adjustments about managing your money. We want to make sure that you are as prepared as you can be. So cut expenses where you can. Raise your income where you can. These are the rules of engagement when it comes to managing your money. Spend less than you earn. The best time to start saving was yesterday. Become the best financial success story that you can be, meaning we don't even know who the Joneses are. Multiple streams of income is a must. Build an emergency fund with 6 to 9 months of expenses. Behavior is what will allow you to reposition yourself. Wealth is determined by what you keep, save, and invest, not only by what you earn. Keep your financial house in order. I pray that something that has been said resonates with you and helps you along your journey to financial freedom. For more information and actionable steps you can put in place to change the trajectory of your finances, definitely check out the page that is at the bottom of the screen after the conference, because again, it won't be live until after the conference. Jeremiah 29:11 says, "For I know the thoughts that I think toward you, saith the Lord, thoughts of peace and not of evil, to give you an expected end." I thank you for joining us for this conference. Also, throughout the conference, you will see additional vendors that we have partnered with that provide practical solutions to some of the needs that will definitely help you. Thank you so much.